Exercise 514 are three of the common ways that a company ends up with a note receivable. The first one is we perform services for a company, and instead of putting it on account, they sign a note and tell us they'll pay us the balance with interest in 4 months, 6 months, whatever. But when we receive the note, we simply do it at face value, so we have $7,000 debit to note receivable and a $7,000 credit to revenue. The next common way that companies will receive a note receivable is they will lend money to someone. It could be a vendor, it could be an employee, it could be an executive, and have them sign a note stating a repayment date and an interest amount. And in this case, that's what happened. They lent $11,000 to a vendor, and the vendor signed a note. So we debit note receivable $11,000, and we credit cash because that's what we lent them. Now, each of these will at some point in the future generate interest revenue, but we're not going to handle that until it happens. And the last one is another common event. This is when a client has a large account receivable, it's past due, they keep putting you off and putting you off, and finally they agree to sign a note receivable with interest and a definite payment date at some point in the future. And that's what happened here. And this company owed us $6,000, so we'll debit our note receivable $6,000, and because they'd already owed us the money, it's not new money, we're taking it out of their accounts receivable, we'll credit their accounts receivable. Three common forms. You get a note for original work, you lend money, you get a note for old or aging accounts receivable.